5 MCQs related to financial analysis. Question 1. Which of the following is used to measure a company's profitability? You have 4 choices: current ratio, debt to equity ratio, return on equity, and quick ratio. Current ratio focuses on liquidity. Debt to equity ratio focuses on solvency, long-term solvency. Quick ratio focuses on immediate liquidity. So the leftover is return on equity. Yes, this ratio compares the profit available for equity shareholders with the equity. So here the relationship is established between the profit and the owner's investment, and in this way it also measures the profitability. So the correct answer is return on equity. Question 2. What does the current ratio indicate in financial analysis? Choice A, a company's ability to pay long-term debt. See, current ratio does not focuses on long-term debt, so A cannot be the answer. Option B, the proportion of equity to total assets. That is like equity ratio, so this is not the answer. Option C, a company's ability to short-term obligations. Yes, this should be the answer because current ratio focuses on liquidity, the ability of the entity to meet its short-term obligations, because it basically compares the current assets and current liabilities, and option D is no relevance here. So the answer is option C, a company's ability to pay short-term obligations. Question 3. Which financial statement is most useful in assessing a company's liquidity? Option A, income statement, B, balance sheet, C, cash flow statement, D, statement of shareholders' equity. Let's analyze one by one. Income statement will communicate the sales, expenses and profits, so it will help us to understand the profitability, so that is not the answer. Cash flow statement will communicate how the cash is generated and where the cash is consumed. Statement of shareholders' equity will give us information about the shareholders' equity and its movement. So the leftover is balance sheet. The balance sheet will list out what are the current assets and current liabilities apart from non-current assets and non-current liabilities and equity. So by comparing the current assets and current liability, you will be able to measure and understand what is the liquidity position of the entity. So answer is item B, balance sheet. Next question. The price to earnings ratio is primarily used to evaluate a company's liquidity, profitability, stock valuation, leverage. What is the answer? See, for liquidity analysis, we make use of current ratio. For profitability, we make use of ratios where the profits and sales are compared, profits and owner's equity investments are compared. Okay. Whereas leverage ratio basically compares the debt and equity to understand the long-term solvency. So what is left over? Stock valuation. So what does PE ratio does? It basically compares the market price with EPS. So that will help us to understand how the stock is valued. So the answer is stock valuation. Next question. Which ratio would be most appropriate to assess a company's efficiency in using its asset to generate sales? The choices are gross profit margin, asset turnover ratio, debt to equity ratio, interest coverage ratio. Let's understand. In gross profit margin, what you do, you compare the gross profit with sales and you will understand the profitability. So this is not the answer. In debt to equity ratio, you are comparing the debt and equity to understand the long-term solvency. In interest coverage ratio, you are trying to understand what is the amount of profit available to cover the interest. How many times interest is covered. So that is not the answer. So what is left over? Left over is asset turnover ratio. In asset turnover ratio, you will be establishing the relationship between the sales and assets, and you understand how many times the asset has been turned over for achieving the sales. So if asset is turned over many times, let's say 2 times, 3 times, it means there is going to be higher amount of sales, and that will bring in more profit, that will bring in more return on investments, right? So asset turnover ratio would be the most appropriate ratio to assess company's efficiency in using its asset to generate sales. So the answer is item B, asset turnover ratio.